First of all, MiFID brought competition to the equities trading. MiFID II aims at sort of mopping up some of the gaps and cleaning up with new technology and new structures. How will this transform equity trading in the future? MiFID II, that is.
Well, I think obviously equity trading has been transformed quite a bit over the recent past, mostly due to competition, and MiFID was a big part of that. And organized exchanges obviously lost large percentages of market share to newcomers into the industry. And I think the aims of the MiFID review are more on transparency, on reviewing actually what took place through MiFID will be quite positive for the market. But I don't see necessarily a significant change in equity activity, for instance, as a result of the review. I think there are other factors that sort of overshadow volume activity in the European markets, and while MiFID helps, it's not going to, I think, have a significant impact on future volumes. More issues like the Eurozone itself and how investors feel about that would be, I think, more overwhelming, far-reaching.
Did you see that with the coming in of T2S, we're going to see similar sort of changes coming in the settlement side?
In terms of
the sort of changes that the original MiFID made to the equities trading market, do you feel that there will be similar changes?
Yes. Well, absolutely. So in terms of competition, I think Target 2 Securities is really transformational, and it really creates a single playing field, at least in central bank money, in terms of settlement. It turns commodity settlement into a bit of a commoditized product, and forcing CSDs to become more competitive on value-added services, which will be good for the market and be good for the clients, because competition usually has the impact of also enhancing services and bringing down prices.
There's a lot of commitment towards regulatory initiatives as well as T2S, but market participants are the people who are actually responsible for doing it and the people who are most affected by it. What changes do you anticipate here, and what changes do you feel will be best for the majority?
Well, just speaking specifically around the market infrastructure, the settlement and custody, I think market participants have to recognize that the journey towards harmonization is not a straight path. And while the benefits will come, and they'll come in the foreseeable future, the immediate impact may surprise some, and the immediate impact will not be necessarily a reduction in prices. May not actually even see your operating costs go down. There'll be high implementation costs and not necessarily an increase in volume. But you're paying for the longer-term good, and that longer-term good is harmonization.
Will the current harmonisation bring us a single securities market in the EU, do you think? And if so, when?
Well, the goal of a single European market, as expressed by the Lisbon Agenda, is obviously at the centerpiece of the future of Europe. I think the market infrastructure aspect of that single market is headed in the right direction. T2S is a big move towards harmonization of the settlement structure. More needs to be done on the legal side, more needs to be done on the fiscal side, but we're headed in the right direction from a harmonization of market infrastructure standpoint. But the Lisbon Agenda was only partially about market infrastructure. It's also the market in general, and obviously Europe has some things to still be concerned about and to work through, which will have a very significant impact as to whether the hopes and the aspirations of the Lisbon Agenda are actually reached.
I mean, this is all about, the markets themselves are global, of course. Is there a concern that some of the regulatory procedures being brought in by the Commission, proposed by the Commission and worked through, are in conflict with the DoddFrank Act in the States?
In terms of general direction, obviously, let's take EMIR and DoddFrank head in the same direction. More transparency in the market, trying to put a restriction on the amount of OTC activity, putting it onto CCPs. But the political and regulatory and a lobbyist process works differently in both countries or in both markets, and tends to lead towards maybe different ultimate responses. And that's where I think we all have to be a little bit concerned. So we started off on the G20 initiatives on the same path. We have to make sure if one turns left, the other turns left, and if one turns right, the other turns right, and there is the risk that one turns left and one turns right. And from a market standpoint, that's something Europe should be very, very concerned about.
Just finally, we had a new man in charge of the Eurogroup who's just taken over from Jean-Claude Juncker, who has a wonderful record, of course. He's coming at a very difficult time. From a market perspective, what would be your advice to the new man at the helm?
Well, that's an interesting question, which would probably take a lot of cerebral power on my part to come up with the right answer. However, having said that, and I don't know if you can focus on the Eurogroup as the entity or the ECB or the committee, it's Europe. And honestly, up until the actions of this past week, I think the Eurozone has done a tremendous job with a big backing from the ECB in terms of taking a situation that most market participants globally thought would have been out of hand by now and basically putting a cover on it in terms of allowing the Eurogroup and other political bodies to work through the Eurozone issues. And I still think that's the case. We have a hiccup this week, and we hope it's only a hiccup with Cyprus, but I think the amount, where we are today in Europe is not where most non-European market participants thought we would be. We're actually in a much better place.